Welcome to my YouTube channel, A+ Tutors, where we teach and upload quality educational resources for students. Today, we shall be considering concepts of cost and revenue in a summarized way. But before we proceed, welcome back. We shall be looking at what is revenue. And when we talk about revenue, what does it mean? Revenue simply refers to the income, the receipts of a firm from selling its finished products to its consumers. And what is total revenue, what is marginal revenue, and what is average revenue. Now, total revenue, what is total revenue? Total revenue simply refers to the total amount of money you generate from selling certain units of your product, and is usually calculated as price of that product multiplied by the number of units sold of that product. Now, if the elasticity of demand for your product is elastic, that is, if the demand for a product is elastic, a producer will not be doing well if he increases the price of his product unnecessarily, because when the price of the product goes up unnecessarily, the volume, the quantity to be sold of that product will reduce, and thus reducing the revenue to be generated by the firm. However, if the demand for that product is inelastic, then it means that the producer can increase the price at least at a reasonable price and continue to sell more, and thus generating more revenue. Now, what is marginal revenue? Marginal revenue simply refers to an extra revenue you generate from selling an extra or additional unit of your product, and usually calculated as changes in total revenue over changes in quantity sold of a particular unit of commodity. Then from there we talk about average revenue, which is the revenue generated per unit sold of a product, average revenue, and usually calculated as total revenue divided by the quantity sold of that commodity. In a perfect market, your price is the same thing as your average revenue, which is also the same thing as your marginal revenue. What do I mean? If you want to calculate the average revenue of your product, it is total revenue divided by the quantity, which will give you the price for which each of that product is being sold for. And because it's a perfect market, if you sell extra units of that product, the additional revenue you are going to generate is the same as the price or average revenue, which makes your price to equals your average revenue and marginal revenue. Now, having talked about revenue, let's look at cost. What do we mean when we say cost? Cost simply refers to all the expenses you incur in the cost of production, the cost of making goods and services available. Total cost. Total cost simply talks about the cost incurred, total cost incurred during the production of certain units of your product. Meanwhile, there's no way you will talk about total cost that will not talk about what we call fixed cost and variable cost. Of course, we have various formulas for calculating total cost. You can either use fixed cost plus variable cost, or you use average total cost multiplied by the quantity produced of a commodity. The other time I mentioned the word fixed cost and variable cost. So what is fixed cost? Fixed cost simply refers to that cost that does not vary with the level of your output. It means that whether you produce or you do not produce, you still incur that cost. And a typical example is the cost of the rent of probably that building where you produce. Whether you produce in a particular month or you don't produce, you still pay for the rent during that month. The next one is variable cost, which is the cost that varies with the level of output. For instance, you want to bake 10 loaves of bread. The raw material or the flour you buy will be based on that. Now, if the loaves of bread you want to bake increases from 10 to 20 or 30, the raw materials you are going to buy will also increase, thereby increasing the cost you are incurring on raw materials, making your variable cost to vary. Now the next one there is marginal cost. Marginal cost simply refers to additional cost to incur when you try to produce an extra unit of a commodity, and is calculated as what? As changes in total cost over change in quantity. So that is change in quantity produced. Now, in marginal cost, the marginal cost will first rise, and as time goes on, it starts going or diminishing. Why? Because the volume of production is increasing. The average cost, which is the cost incurred per unit produced of a product, and is calculated as total cost divided by quantity produced of a commodity. Now, average fixed cost. Don't forget, we have talked about what fixed cost is, that cost that does not vary with the level of output. So average fixed cost simply refers to that fixed cost to incur per unit produced of a commodity, and usually calculated as total fixed cost divided by the number of quantities that is being produced at a particular time. Then we also talk about average variable cost. Don't forget our variable cost as earlier discussed, and it is variable cost incurred per unit produced of a product, which is also calculated as what? Total variable cost divided by quantity produced of a commodity. Now, in a perfect market, a firm will be at equilibrium in a situation whereby its marginal revenue equals its marginal cost. Please take note of that. Having talked about cost, talked about revenue, there is the need to look at the difference between the two, and that is where we either talk about profit or loss. Now we'll be talking about profit here, and a situation whereby there is excess of revenue over the cost or expenses incurred in the cost of production. And what are the various formula for calculating profit? We have either you say profit equals total revenue minus total cost, or you say profit is calculated as marginal revenue minus marginal cost. Every firm must know that a firm will have to shut down once its profit is less than the average variable cost. Average variable cost. Then average variable cost. If the profit a firm earns by selling its product is less than the average variable cost, then it means that business can no longer cater for itself again, and thus the need to shut down or the need to stop operating. And that's the end of our class for today. However, I need to quickly let you know that we have our compiled WAEC questions on concept of cost and revenue, the solutions to various calculations from compiled WAEC question that is coming very soon, and we want you to be on the lookout for that. If you love what we do at A+ Tutors, we please implore you to subscribe to our channel, like and share